In 2019, WeWork, a company offering flexible office spaces, commanded a private valuation of an astonishing $47 billion. Founded on the promise of community and innovation, its rapid expansion appeared to validate CEO Adam Neumann's vision of a global physical social network. According to reports from the Wall Street Journal and Forbes, this valuation positioned WeWork as one of the most valuable startups globally, eclipsing long-established real estate giants. But beneath the veneer of disruptive innovation, financial analysts were beginning to scrutinize a fundamental question. Was this valuation grounded in a sustainable business model, or was it a house of cards built on venture capital speculation? Adam Neumann, WeWork's co-founder, championed a vision extending beyond mere office rentals, selling an ethos of we over me. However, the core of WeWork's business model, as detailed by SEC filings prior to its attempted IPO, was a real estate arbitrage strategy. The company would sign long-term leases, often 15 years, on large commercial properties, then subdivide and rent them out on short-term, flexible agreements to tenants. Critics, including analysts from NYU Stern's Scott Galloway, argued this model was inherently risky, exposing WeWork to significant market fluctuations and a massive mismatch in liabilities versus assets. WeWork's explosive growth was largely fueled by SoftBank and its Vision Fund, led by Masayoshi Son. SoftBank invested an estimated $18.5 billion into WeWork over several rounds, according to reports from Reuters and Bloomberg. These massive capital infusions pushed WeWork's valuation to unprecedented levels, creating an environment where growth was prioritized over profitability. Son's belief in Neumann's disruptive vision, coupled with SoftBank's strategy of deploying vast sums into high-growth, often unprofitable, tech-adjacent companies, profoundly influenced WeWork's trajectory. This capital allowed WeWork to expand globally at an aggressive pace, masking underlying financial vulnerabilities. As WeWork prepared for its 2019 IPO, closer scrutiny from regulators and the public revealed significant corporate governance issues. Filings highlighted numerous instances of Adam Neumann's self-dealings, including trademarking the We brand and charging the company $5.9 million for its use, as reported by the New York Times. Furthermore, Neumann borrowed hundreds of millions from the company and engaged in lavish spending. These revelations, coupled with a complex ownership structure and dual-class shares granting Neumann outsized control, raised serious questions about accountability and investor protection, causing concern among potential public investors and analysts alike. The pivotal moment arrived with WeWork's attempted IPO in 2019. The S-1 prospectus, intended to entice investors, instead exposed the company's staggering losses and precarious financials. In 2018 alone, WeWork reported a net loss of $1.9 billion on $1.8 billion in revenue. Public market investors, unlike private venture capitalists, demanded a clear path to profitability and sound governance. The market's reaction was immediate and brutal. According to reports from CNBC, institutional investors balked, leading to a dramatic repricing. Within weeks, the anticipated $47 billion valuation plummeted, with analysts suggesting an IPO valuation potentially under $10 billion, effectively derailing the offering. Following the IPO failure, Adam Neumann was ousted as CEO but departed with a reported $1.7 billion golden parachute from SoftBank, an exit package widely criticized by observers like the New York Times. WeWork underwent significant restructuring, laying off thousands of employees and attempting to cut costs. Despite these efforts, the challenges persisted. The COVID-19 pandemic further impacted demand for office space, exacerbating WeWork's financial woes. Ultimately, after years of trying to right the ship, WeWork filed for Chapter 11 bankruptcy in November 2023, listing billions in both assets and liabilities, a stark culmination of its initial overvaluation and flawed execution.